Imagine you're at an all-you-can-eat buffet. Suddenly, the manager doubles the price overnight. Would you go back tomorrow with the same appetite? Now imagine that buffet is the economy. That price hike? That's what happens when interest rates go up. Suddenly, everyone starts thinking twice before loading up their plates, like shopping carts and credit cards. And here's the kicker. That hesitation is exactly what central banks want. If that sounds like financial wizardry mixed with psychological warfare, keep watching. This is how the fight against inflation begins. Let's start with a little drama. Inflation is the villain. It erodes your money's value. That $5 coffee? Suddenly 6. Groceries up 15%. Rent? A nightmare. Your wallet is on a diet, losing weight fast. So who's the hero? Central banks, like the US Federal Reserve, armed with their mighty tool, interest rates. But what's the game plan here? How does making borrowing more expensive stop inflation? Let's break it down. When interest rates rise, loans cost more. Mortgages mean higher monthly payments. Car loans drain more cash. Business loans lead companies to rethink expansion plans. That's the point. Central banks want people to borrow less. Less borrowing means less spending. Less spending equals less demand. And that's a chokehold on rising prices. Imagine the economy on a wild sugar rush. People buying, companies selling, prices climbing like hot air balloons. Raising interest rates is like tossing a wet blanket on that sugar high. When loans become pricier, consumers pause. They hold off on buying that second TV or upgrading their iPhone. Businesses also slow down. They hesitate on hiring, investing, and raising wages. The economy takes a deep breath. When the frenzy stops, prices stop climbing. High interest rates don't just stop borrowing, they tempt you to save. Boring savings accounts or bonds pay more in interest now. Passive income? Yes, please. More saving means less money flying into stores or online carts. The heat comes off the economy. Inflation occurs when too much money chases too few goods. If people borrow less, spend less, and save more, demand cools. Businesses notice customers backing off. They stop raising prices, and some even lower them to stay competitive. Inflation gradually slows down. It's not magic, it's monetary policy doing its job. But it's a dangerous dance. Raising interest rates is like giving the economy medicine with side effects. It fights inflation, but if overdone, boom, recession. Companies lay off workers and confidence plummets. Central banks walk a tightrope, slow inflation without crashing the economy. They're like the Goldilocks of monetary policy. Not too hot, not too cold, just right. One cruel joke of economics, interest rate hikes take time. Think 6 to 18 months. It's like turning a giant cruise ship. You spin the wheel now, but the ship pivots later. During that delay, people complain, why isn't anything changing? But behind the scenes, the gears are turning, quietly, relentlessly. So, why does raising interest rates fight inflation? Because it cools spending, encourages saving, slows the economy, and crushes rising price momentum. It's not glamorous or fast. It definitely doesn't win popularity contests. But when your money loses value weekly and prices soar, that cold, calculated rate hike might be the hero you didn't know you needed. Until suddenly that $5 coffee is $5 again. If you found this video helpful, subscribe for more informative content and share your thoughts below.